The 2-year anniversary of the collapse of Lehman Brothers has just passed, and I asked Francois Nordhof of BCP how investors' attitudes has changed.
Unfortunately for investors, there are still huge volatility ahead of us. Even if currently most actors believe that volatility normalized, there are certain turbulences ahead of us.
Is there anything that can be done in terms of regulation to try and restore confidence, or is it just a matter of time and waiting for confidence to come back naturally?
Yeah, well, indeed, regulation is one matter, but regulation to a certain extent is also a risk for investor. Take, for instance, Basel III regulation standards. Now they have to be implemented. We have immediately seen what were the impact, even if the regulation start has been slightly postponed compared to what was expected. Those regulations will not be able to be avoided by the major banks, and therefore some recapitalization will have to take place for most major banks. For equity investor, we had a marvelous rally in 2009. In 2010, it's going to be much more difficult to either outperform the market or even to generate positive return on the equity side due to these fears of dilution, capital increases, which could surprise some actors, which in the long run is a good thing, because in the long run, indeed, you are stabilizing your core or making your core capital bigger, comfortable. So it's much more, on the long view, it's positive. Indeed, in the short term, it's exactly what investors do not want to see in the market.
So where are investors looking now? Because if you look at the S&P 500, that's still down compared to the pre-Lehman Brothers collapse. So where's the money gone, as it were?
Well, indeed, if you look in terms of asset allocation, currently we had the flight to quality in the recent summer months. We have seen sovereign bonds rallying marvelously. Even on the long end, investors were taking, to a certain extent, huge risk on the duration, making their duration longer on sovereign bonds and earning money, quite a lot of money. For us, clearly, as an investment advisor, currently we are clearly not allocating money to sovereign bonds. At first, because we think it's fairly priced, but also because we think in Europe, mainly, there are some still risks. Not default risk. Everybody is speaking about default risk of Greece, and that Greece is going to be bankrupt. Maybe, maybe not. We will see anyway. That's the future. But clearly, the risk of losing money in this asset class is bigger than to earn a lot of money in the near future. Therefore, we advise clients to say, okay, go to corporate bonds if you want to take a certain risk, a certain corporate risk. Corporate bonds, why? Because at first you have still a positive spread. There is some spread, some corporate spreads to be catching. And moreover, we should compare it, as we compare it with the historical average, we should be aware about the balance sheet quality of the company, of the issuers. The balance sheet quality of the issuers is currently much in better shape than it was 10 years ago. So comparing an average with the current environment is a wrong idea. In fact, there is much more to cash in and profit on corporate bonds.
I was reading a summary of the world economy produced by BCP,
yep.
and one of the things they advised was buy gold. Is that something which you personally would advise? And because it seems that this gold's potentially going to create its own bubble if it just keeps on appreciating.
Indeed, we have currently a gold bet in our discretionary portfolio for a very simple reason. We want to reduce volatility generated by conventional financial assets like bonds, like equities, or even hedge funds. For us, that was the first reason. There is a second reason. The balance sheets of the central banks currently is unbalanced. Compare the balance sheet of central banks 3 years ago to now, you will see that there is indeed, due to quantitative easing, the balance sheet size increased, but the gold ratio decreased dramatically because the banks were not able to build up inventories of gold, and now to a certain extent they are going to catch it up. They will not retrieve the same ratio than they had before the crisis, but on the I would say 6-month, 12-month or a time horizon, central banks will permanently buy gold to restore their gold ratio within their balance sheet due to the fact that they have this ongoing quantitative easing. That's for us a way to say, yeah, you need to have a certain extent of your portfolio into gold. And for instance, if we look into one of our portfolio, we are establishing a 5% position in a balanced portfolio, which is 50-50 fixed income equity.
And you can get the complete set of interviews and photos at the Geneva Forex Events website. Goodbye for now.